Good morning, everyone, and welcome to our second webinar for the year. A big thank you to all of you that have taken the time to dial into our webinar today and for the many questions we received during the registration period. My name is Rochelle Jagger, and I'm delighted to be the host of our conversation today. I'm also joined by my colleague, David Nee.
Hello.
David is the Chief Investment Officer at Prudential, and he's also the co-portfolio manager of the Prudential Inflation Plus and Balance funds. Welcome, David.
Thank you.
Before we kick off the conversation today, I'd like to encourage you to continue to submit your questions in the live Q&A box. We do have a team behind the scenes collating the various questions, and we've set aside some time at the end of the presentation to go through some of those questions. CPD points will also be available for the presentation today. David, it's certainly been a remarkable 12 months. I think despite the tough market conditions, the unit trust industry has taken in record inflows for the past 12 months of 213 billion rand. Now, what's quite interesting is if you look at these flows, the majority of them went to the lower risk fixed income categories. And these funds typically invest predominantly in cash type investments and to some extent in bonds. On the screen, we show some of these flows over the last year and over the last 3 years. And we've grouped some of the categories together. And what you can see is that over the last year, the interest-bearing and multi-asset income category took in 207 billion rand in flows, the majority of the flows for the year. And if we extend this analysis over 3 years, those sectors or those categories took in excess of 400 billion rand in inflows. And this is going to the lower risk fixed income type categories. In comparison, some of the other categories took in very little flows. One that I'd like to mention is the remaining multi-asset class categories. And the reason I mention this is that typically these categories take in the majority of flows over time as investors look to these funds for long-term retirement savings. So I guess the picture shows that investors have become extremely risk averse over the last 3 years. David, a lot of these investors have now missed out on the rally we've seen in markets over the last 12 months. And I'm sure many of them are asking themselves whether there are still any opportunities left to earn decent returns going forward from the market. You were sitting here about a year ago. You had a tough conversation about investment markets. How's the return picture changed over the last 24 months?
Yeah, thanks, Rochelle. Look, it's been an extraordinary period. In my 30 years of working in financial markets, I've never seen anything like 2020. The run up to in the three and even 5 years in the run up to the COVID period, returns had been quite challenging, particularly in South African assets, and we'd been highlighting the extent to which assets were becoming cheaper as those valuation indicators shifted. And we were leaning into those assets being overweight. And we can see just in the slide that the 12-month returns to the end of March 2020, equities were down 25%, and property a massive 50% fall in that year. And as I say, that followed on from already some profound disappointment in absolute returns from clients, which I think had been one of the driving forces behind their appetite to buy cash assets. Cash had been, one of the best, if not the best performing asset in recent years. And people seem to be losing faith in the ability of kind of real assets to deliver the returns which they wanted. We've always highlighted to investors that we've valuation focused at Prudential, and that valuation is a strategy is one that works over the medium term. One never knows exactly how or when the valuation is going to bite, And consequently, you need to kind of position the portfolio, your portfolios, to take advantage of assets when they're cheap, and that's exactly then what we saw in the 12 months to March this year, where suddenly South African equities managed to rally 50%, and property also was up by over 30. Conventional bonds and inflation-linked bonds both up high teens, 17%. So getting kind of returns that we would generally expect from equities off those asset classes. And that was what was extraordinary about that was it was against a background of the worst global recession in 70 years. So, if you'd had perfect foresight of the macroeconomic data, there was no way you would have anticipated that you were about to kind of experience the returns from markets. And I think that clients clearly were in disbelief about the recovery in financial assets, as we can see from the flow data, where over 200 billion went to cash and cash plus. But the key question, one of the key questions that we're going to hopefully provide some color on through the course of this presentation is, is this it? Is the rally that we've seen all that clients can expect? Have they missed out? And what's still left on the table?
Sure. I mean, that's certainly quite a remarkable recovery in markets. And I think if you offered any investor those returns in March last year, they would have grabbed them with both hands. I mean, David, naturally, we've had a few questions on the recent performance of Inflation Plus and the balance funds. Going into March 2020, we were overweight risk assets, so we took some pain in terms of performance. Can you give us a sense of how these funds have performed over the last 12 months?
Thanks, Rachel. I mean, if we kick off with the balance fund, then not only were we buying risk assets before we'd really even heard about COVID. I mean, as equities had offered an increasingly attractive opportunity in recent years, given their poor performance, we were adding that asset class very incrementally into the balance fund and the Inflation Plus fund. And then, I mean, it's worth bearing in mind that obviously when we reached the middle of February, we thought COVID was a Chinese problem. 4 weeks later, our equity market was down over 40%. And so the speed of the shift in perceptions was extraordinary. What we did in response to that is we not only did we maintain our weight in equities, because as you can imagine, as the asset class underperforms, then your weight naturally falls. So we were adding as the market fell, and we kind of increased our allocation on top of that. And we'll come to that later. Yeah. So, we were very fully weighted in those risk assets, and we added to them as they became cheaper. And the benefit of that is evident in the returns which have come through in the last 12 months. The balance fund is 5% ahead of the medium fund in that multi-asset high equity sector. And if we look at Inflation Plus, actually even more so. They're over 6% ahead of the sector median. And those robust returns clearly offer a challenge to, I think, clients who went and parked their funds in cash, which only returned 4.5% in terms of the money market funds, and a little bit more from multi-asset income funds. So some huge gaps there. And I think, one, it highlights the lumpy way in which returns are often delivered. I mean, previously we've shared with clients research that we've done showing if you missed the best 5 weeks in equity markets in the last 20 years, you'd have missed half of the return. So being out of cheap assets is always a significant risk, and we saw that manifest in the period up until March of this year.
David, that's certainly quite a big gap between the performance of those multi-asset class funds and cash, and certainly quite a quick turnaround in performance. I'd like to unpack maybe some of the more recent asset allocation decisions that were taken in the funds. Obviously, these funds follow an active asset allocation approach, which the team has been running for in excess of 20 years. We saw some extreme price movements in markets. Did this perhaps prompt you to make any changes in the funds over the last 12 months?
Yes, yeah, it did, Rachel. I mean, it's always very challenging um, to find yourself in a situation where you're overweight an asset that is falling dramatically, and clearly that was where we found ourselves in early March. We owned equities and bonds, and both of those assets posted significant negative returns. And the natural inclination is to want that pain to stop, and therefore to try and reduce your exposure. But clearly our investment process, highlighted that those assets are looking, even cheaper than they were before. And consequently, as I touched on earlier, we worked hard to both maintain our weight and then add to our weight, particularly to equities, as the equity market fell so sharply.
Sure.
So if we look at some of the active changes that have occurred in the last 12 months in the Inflation Plus fund, we can see that there were a couple of sizable changes that are worth highlighting. We added to South African equity out of foreign equity, and we'll come to that, the specifics of that a little bit later. But our total equity exposure is still close to the 40% maximum allowed in that category. With the fund on the left-hand side, the pie chart split, we can see we currently own 39% in total equity. We also added kind of a little bit later, after March, into South African bonds. Bond yields, 10-year bond yields sold off to kind of low teens levels, that again we hadn't seen for 20 years in South Africa, even whilst South African inflation was very contained. So the prospective real yields, in our view, were extremely compelling, we saw that as an opportunity to add to that asset class. And there, quite a lot of the funding for the increase in South African bonds came from South African property. Again, we'll come to some more details of property later, because I think it's there was some clients have been asking questions for a while about our property allocation.
Sure.
In Inflation Plus. But there are definitely some long-term challenges to questions about what's the demand for retail space. Is South Africa going to be going more into online retail?
Yeah.
What's the demand for office space? Lots of companies have announced they're going to be operating a much more flexible working policy going forward, and do they need the same office space that in Prudential itself is contemplating how it's going to kind of adopt policies going forward about work from home and so on. So that, along with kind of some challenges with weaker balance sheets of some of the property companies, I think led us to believe that the bond yields offered a superior kind of risk-adjusted return. So those were the main changes kind of in Inflation Plus. It was slightly different in the balance fund, if we turn to that now. And there you can see actually that the overall equity weight kind of reduced slightly.
Yeah.
The foreign equity change was similar to Inflation Plus, but here we actually reduced our South African equity exposure. And the reason for that was that, actually, by the end of March, the fund already had well over 70% in total equity exposure. So, we've reduced that by close to 5% over the last 12 months as the markets have rallied, because of the fact that we were able to be kind of more fully weighted in equities, given the valuation signal that manifested itself, by the end of March. And because the balance fund isn't affected by the 40% cap that clearly affects multi-asset kind of low equity funds.
Sure.
The other main beneficiary was South African bonds, and that's the same story that applied elsewhere. But it's important I think, to emphasize that we still think there are attractive returns available from equity assets, I mean, particularly South African equities, and we remain more than 2/3 of the fund is still exposed to equities, and we're also still fully exposed to foreign assets.
Sure.
Although the split between equity and foreign bonds has shifted. As foreign equity has become more expensive.
David, we've had a few questions on SA equity and the foreign component of the fund, and we'll get to that a bit later. Maybe you want to start with getting into some of the detail on these asset allocation changes, and perhaps we can start with bonds. I think it's quite rare to come across investors that get very excited about bonds, particularly SA bonds, given the fiscal position in South Africa. Yet, if you look at the returns you've shown, I mean, SA bonds have delivered equity-like returns, in fact, in excess of equity-like returns of 17% over the last year. You've been constructive on SA bonds for quite some time. You were overweight going into the crisis, but you've subsequently also added to that position. I mean, clearly you see there's still being opportunity for SA bonds. What is your comment on that? Are there still promising returns to come from South African bonds?
I mean, we certainly think so, Rachel. I think there are a number of important factors to consider when thinking about the attractiveness of South African bonds, and it certainly is fair to say I think they've had a really bad rap. And there've been lots of reasons to doubt whether they genuinely are going to offer kind of compelling real returns for investors. And perhaps the starting point there, as you mentioned, is to focus on not just actually the budget deficit, but also the other deficit that I think investors worry about, which is the current account deficit. So that twin deficit problem, the current account, South Africa has run a current account deficit in general, which means that we need foreign capital in order to finance our requirements, for investment and to cover the government revenue shortfall, and that has created a vulnerability as far as the currency is concerned. What a lot of clients may not know is that the significant rise in resource prices in the last 12 months, along with a reduction in import demand, means that South Africa is now running, as we can see in this slide, the largest current account surplus since the mid-1980s, running a current account surplus of around 5%, which is a huge reversal, having only 5 years earlier run a current account surplus of -5%. So our external position has improved significantly. Clearly, we wouldn't expect it to kind of stay at that +5% level. South African economy is going to recover and import demand is going to increase. But in the recent forecast that the Reserve Bank released, still 2 years out, South Africa will only have a small current account deficit, much smaller than the average, in the last 20 years. So, there's, I think, a positive story there that perhaps has been underappreciated. And then on the right-hand panel in this slide, the second, I think, positive data surprise that's germane to the question of bonds offering value is coming on the revenue side of the fiscal accounts. So both, if we look here, we've got the percentage change in kind of average tax receipts of income tax and corporation tax. We're looking at a 6-month average just to smooth through the noise in the individual monthly collection data. But we can see since October that we've had a significant improvement in the tax take, and it's running kind of well ahead even of the February budget numbers that were recently published. So what that's enabled National Treasury to do is to reduce the size of the weekly bond auctions. So you've got less supply coming to the market, which is clearly helpful. But also, more important than that, is that it assists National Treasury in stabilizing the budget deficit. And I think that was one of the narratives that was getting a lot of press and concerning investors, that we were on an inevitable spiral to default because we weren't going to be able to stabilize our fiscal position. And I think, this certainly says that that there are reasons to kind of be more hopeful, that not that there isn't a lot of work to do on the fiscal side, but it's certainly not all doom and gloom. So that's the first point to make, that we've got some positive macro developments. The second point to make is just about the absolute level of South African yields against some of its international peers. And here we can see South African 10-year bonds compared in red, compared to emerging market, local currency emerging market bonds in grey, and US bonds in the lilac colour. So, because particularly, I think one of the other stories that's often told is that as US interest rates are going to rise, emerging market bonds are going to have a really difficult time, because investors are going to say, well, I don't need to own emerging bonds because I can get better yields from the US than I could. And I mean, there are a number of problems with, I think, that narrative. The first one is that it hasn't been true in the past. So, in the run-up to the global financial crisis, US interest rates were rising. Then Chairman Greenspan, who was chair of the Federal Reserve at that point in time, was increasing interest rates, and US bond yields were rising, and yet South African bond market was rallying hard. So it's certainly not always the case that the two markets have moved lockstep. Yeah. So it's worth bearing that in mind. And then the second point is just to look at this chart and look at the valuation gap that you can see between South African bonds and US bonds. And it's as wide as it has pretty much ever been, bar one or two tiny spikes. You've got more than an 8% gap between the yields on those two markets. So there's a huge buffer in there for the potential for US rates to rise. And indeed, we can broadly see, I mean, US bond yields have risen over 100 basis points from the low over the last kind of 6 months as the vaccine rollouts created an optimism about growth and concerns about inflation. And I'll touch on inflation in a second. Yeah. And South African yields are essentially unchanged over that period. And then that does lead me to the final point, which is, globally and to some extent locally, investors have started becoming concerned about rising prices. The starting point for that concern is that oil prices and food prices and goods prices obviously were at very low levels during the COVID period and the immediate aftermath. And they've normalized somewhat as the economic outlook has normalized. And we're going to get what we call a base effect when we compare March this year, for instance, to March last year. Oil prices in March last year were $20. Oil prices now are $60. And so you've got that coming through. The question is whether that's a temporary phase or whether that will be an enduring jump. And I think Jerome Powell, current chair of the US Federal Reserve, has been very clear that their view is that the rise in inflation they're expecting in the US, for much the same reasons, is going to be very temporary. And our own Reserve Bank has said something similar. Just this week, then the Reserve Bank released its monetary policy review. And when we look at that, their forecast for inflation 2 years out is for inflation to still be around the midpoint of their target band. That band is 3 to 6%, so the midpoint 4.5%. And that's more or less where they expect inflation to be out in 2023. So they don't see any significant pass-through going into broader inflationary measures, but you will get this temporary jump in the annual inflation rate from currently very subdued levels. So, if you think about inflation in South Africa around 4.5% or even 5% as a medium-term level, and and I think the Reserve Bank has done a fabulous job in the last 2 decades of anchoring inflation expectations lower. We can see in the BER inflation expectations survey, those expectations are now pretty firmly anchored around that 4.5% point. And then you compare that to current nominal bond yields,
Yeah.
10-year bond yields around 10%, 20-year bond yields over 11%,
Sure.
then that real yield that's on offer seems to us to be compelling.
David, thanks. Your comments on inflation are certainly interesting. I think it leads quite well into the next asset class that I'd like to talk to you about, and that's inflation-linked bonds. You have quite a sizable position in the Inflation Plus Fund to inflation-linked bonds. It's one you've held for quite some time in the portfolio. In a previous webinar, you indicated how much that actually added to returns through time to the portfolio. You continue to hold the asset class. In fact, in the last 12 months, you've increased the exposure and you've gone from a neutral to an overweight position. I also see that some of our competitors are now increasing their exposure to this asset class. Just given your comments on inflation, why do you continue to hold this asset class, and why have you increased the exposure to an overweight?
Thanks, Rochelle. Look, I guess to start with recapping on why we own inflation-linked bonds in the Inflation Plus Fund, we've done a lot of quantitative work looking at how to achieve the best risk-adjusted return for clients over the medium term. And we found that inflation-linked bonds, there are periods when inflation-linked bonds are very helpful in the portfolio. So in the webinar last year, we showed that over the previous 10 years, inflation-linked bonds had added about a third of the total return in the portfolio, but that had been primarily driven by the returns in the 5 years after the global financial crisis. And then we know that the 5 years up to kind of March 2020 were very disappointing in terms of inflation-linked bond returns. And I think, people kind of lost faith in inflation-linked bonds, and it became a very unloved asset as a result of, I think, those disappointing returns, particularly when compared to cash.
Yeah.
And investors would clearly point to the fact that they could achieve real returns from cash of 2 or 3% from a multi-asset income type product, and that with some certainty. And there we were with 20% of the Inflation Plus Fund in an asset that was delivering half of that.
Yeah.
Last year in the year to the end of March 2021, inflation-linked bonds delivered a 17% return. Cash delivered a 4.5% return.
Yeah.
So there were these periods where, as I say, it does fire. We never expect all assets in a multi-asset portfolio to necessarily fire at the same time, but you want to combine assets that over the medium term are going to give what we think is going to be the best risk-adjusted return for clients. So why have we been adding inflation-linked bonds more recently? And the answer to that we can see, in this slide where we show the last 20 years history of inflation-linked bond yields, which is the red line, compared to cash rates, adjusting cash for current inflation. So we're also comparing what we would call real cash. If we just focus for a moment on the right-hand side of this slide and look at the gap that's opened between those two, even given the strong performance that we've had from inflation-linked bonds, and we're looking here at kind of 10-year inflation-linked bonds, you still can see real yields on offer of around 4% from those longer-term inflation-linked bonds, compared to about 0.5% real interest rates currently available on your cash assets. Over this 20-year period, we have seen a similar situation arise on 3 previous occasions. And if we highlight those, this yellow line here is the difference between inflation-linked bonds yields and real cash yields. And we've highlighted, as I say, those 3 particular periods where that gap was very elevated, where inflation-linked bond yields were significantly above real cash yields. And then we've just shown what happened over the next 3 years in the table, what happened in the next 3 years in terms of the real returns from those 2 asset classes. And in every case, inflation-linked bonds beat cash by a significant margin. And in the post-global financial crisis period, and in the post kind of Euro crisis period, that gap between cash and inflation-linked bond returns over the 3 years, and these are annualized returns, was close to 4%. And I think that does for us that both that history, although we always appreciate that history, rhymes rather than repeats, so every situation is different, but both the history and our valuation-orientated process suggests to us that there are there's an attractive real return opportunity being in inflation-linked bonds, and we've shifted some of our exposure from SA cash into inflation-linked bonds as a result of that.
Great, thanks, David. I'd like to perhaps shift the conversation up the risk spectrum, and I'd like to chat a bit about listed property. It's quite a polarizing topic, I think, within the industry. I mean, quite clearly, the sector's taken a lot of strain. With COVID, capital values have been slashed, distribution rental yields as well. You've been consistently cutting property over the last while to the extent where now within the balance fund you have a 2% allocation to listed property, and within Inflation Plus that exposure currently sits at around 5%. That sort of tells me that you're not very excited about the prospects for listed property going forward. Is there just too much risk in the sector, or is it just around the uncertainty going forward?
I mean, I touched earlier on the fact that there definitely is an uncertainty element for listed property, but it's certainly not the case that we're not excited about the returns from property. Property is still priced in aggregate to deliver a significant inflation-beating return over the medium term. The question from an asset allocation perspective is always where can we find the best risk-adjusted return? So perhaps another point to make up front is that we are increasingly finding a number of individual attractive opportunities within the property sector. Companies that went into this downturn with stronger balance sheets that were tarred with the same brush, or companies which have moved rapidly to shore up their balance sheets, and pay down debt, and consequently within our specialist equity funds we've been adding property exposure in certain individual stocks. But from an asset class perspective, there are still some significant challenges. Fundamentally, as I noted, we look at office, we look at retail, we're not sure where that's going to go, and there are still a number of property counters which have weaker balance sheets that are challenged. And we can see perhaps some of the effects of these issues in property if we look here on the slide just showing the forward distribution yield from the property sector. So these are kind of all of the property stocks listed on the JSE, and the distribution yield from those stocks on average. We've got a long history here, and we as the weaker economic growth from the kind of Zoomer years started to bite, then we can see that property yield rising in 2018 and 2019, and that was generating kind of underperformance that was quite painful, especially in our Inflation Plus fund. So we had kind of capital losses associated with that rise in yield. But the spike after COVID was really extraordinary, and the sector went from offering a forward distribution yield of 10 to a forward distribution yield of 20. We're now back at kind of pre-COVID levels of yield, but we're not back at from a performance perspective, we've still got a significant performance gap. And how has that occurred? And I think it's useful to understand what's happened there. And if we look at the next slide, we can see that the issue for property has been that as the fundamentals deteriorated and as they've struggled to capture rents from their retail counterparties, in particular, I mean, Growth Point results came out a few weeks ago. The rental yield, the rentals in the waterfront, for example, prime retail they're only collecting half of what they were previously. So, obviously we've seen these downgrades, and this is reflected in this grey line here. We've scaled it off the left-hand axis, but you've had kind of over a 30% cut in expectations for the distributions 12 months out. And if we then overlay that with the property index on the right-hand scale, if we compare these two, the property index was kind of close to 12,000 a year ago, and the dividend yield was then about 10%. Dividing the dividend just by the index level, we're still at kind of close to 10%, but obviously the distribution is 30% lower, and that's where kind of value has been destroyed. And I think that there continues to be kind of ongoing concern about when these distributions are going to be able to recover, and what's going to be the long-term growth rate of those distributions. Now, as I say, there are some companies where that uncertainty is more than priced in, but in aggregate, that it remains, I think, an overhang for the sector. And so I think that's a fundamental challenge. And then on top of that, if we look at this next slide, where we compare 20-year bond yields in South Africa against the same forward distribution yield on property, bonds have performed generally poorly because of the reasons that I went through earlier: concerns about inflation, concerns about twin deficits, and so on, and rising US yields. And as a consequence, the forward distribution yield on property is now actually below the 20-year bond yield. We hadn't seen that until I think for quite some time. And for us, it just has created a kind of an opportunity to switch from property into bonds and generate, I think, in our view, an improved risk-adjusted return for clients. But I don't think, as I say, that detracts from the fact that there are going to be definitely some property stocks that are going to double, and if South Africa growth can get going again, I think the sector can do well. But I think for the time being, we're happy to earn 11% plus yield in government bonds, and just kind of patiently wait to see how some of the fundamental factors pan out for the property market.
Yeah, I mean, certainly you do still have some exposure to property within the funds. We received quite a bit of questions, David, on equities and on the currency. I mean, I guess it's understandable given the sort of quick risk-off, risk-on environment we've just been through. You mentioned in your earlier slide that you decreased your offshore exposure. You've also increased your weighting to SA equities. How does your view on SA equity versus offshore equities stack up? And can you maybe talk us through some of the recent trades you've made within the portfolios?
Thanks. Yeah, look, I mean, equities are always going to be one of the main assets in terms of driving the end performance outcome for clients. And weak equity returns in the 5 years to March 2020 were one of the main reasons why kind of multi-asset equity orientated products struggled. If we start with the valuation story, and our process is rooted there, so I think that's important. And look at one measure of valuation, which is the price to book of the SA equity market, which is the red line on the chart, and we compare that to the S&P as the bellwether for global equities. The gap between those two valuation indicators at the far right of the chart, current price to book on SA equities of around 1.7, on the S&P at 4.4, it is taking us back to where we were in the emerging market crisis of the late 1990s, that degree of kind of valuation misalignment. And if we look at the South African price to book, you know, in the GFC, kind of in early 2009, then, you know, actually we were cheaper in kind of at the end of March 2020 than we were in the GFC, and we know what happened after that. You know, the SA equities, you know, in the 5 years after the GFC rallied, you know, 200 to 300%. So clearly we don't know what's going to happen exactly in the next 5 years, and we will come at the very end of the presentation to some of our thoughts on what prospective valuations are on offer and potential returns for clients. But here we would, you know, I'm keen to note just the cheapness of South African equities. Even at a 1.7 price to book, we're still 20% below our long-term historic average price to book for the market, and that in its own right is a profound indicator of cheapness. Never mind relative to global equities, which have clearly done so well. And if we look at the previous period when we had a similar kind of gap, which was at the end of the dot-com bubble, and I'm not saying here that we're in exactly the same environment, but just as perhaps maybe a kind of rhyming theme to the current environment, you know, in the 10 years from the end of 99 to 2009, in rand terms, the S&P delivered actually a slight negative return, and South African equities delivered nearly a 17% per annum return. So we would suggest that you're taking a significant risk to be offshoring your equity exposure at this point. And on that, it's worth noting that, you know, the other asset class alongside cash that actually had kind of reasonable positive flows was offshore.
Sure.
So, you know, clients, you know, took their cash and put it into offshore assets when they were already, relative to SA assets, you know, quite expensive. I mean, if we look at what we did, if we start with South African equities and just look at the index level, which is on the left-hand scale here, and we've indicated points at which we increased our equity weight. So, you know, as the market fell, we were buying equities just to hold our weight, and then we increased it, you know, in early April, and then again as we started to have increased certainty about the way in which the recovery was going to manifest itself and improvements in expectations for earnings. So, you know, on a number of occasions through the sort of 6-month period, kind of running from March, April through to October, we were adding our exposure to SA equities in inflation plus. And what were we doing in foreign assets? Well, we were doing the reverse. Here we're showing the grey line is the rand dollar on the right-hand scale. You know, within the course of just a few weeks, rand dollar went from 15 to nearly 19. Many of our peers allowed their offshore exposure to rise as that happened, whereas our valuation-based process kind of highlighted the fact that the rand was looking very cheap. At one point when it was kind of 18, 19, in our view, 20% cheap to longer term fair value. And we, on a number of occasions, reduced our exposure to offshore assets and hard currency and brought that back into rand. You know, we can see the rand has recovered now all of those losses and actually more. It's stronger now than it was kind of 12 months ago. Yeah. And in the returns chart that we showed at the beginning, you know, South African equities delivered a return that was twice the global equity return in the year to March 2020. Yeah. So, you know, it just you know, highlights, Rushil, the extent to which, you know, following a valuation-based process. I mean, you don't know when exactly the returns are going to be delivered, but sometimes that can happen very abruptly, as it has here. You know, over the course of kind of 9 months, you've had a significant outperformance coming from SA assets, and our process benefited from that.
Yeah, It certainly seems like you've been quite active over the last 12 months. David, I think you've made quite a compelling argument on some of the asset classes that we've spoken about today. And certainly, I think if you look at your asset allocation, it reflects those opportunities in those asset classes. You know, quite a few investors have missed out on this big rally over the past 12 months. Can you perhaps give the audience a snapshot of what investors could reasonably expect from this point going forward? Yeah, are there more returns to be found in the market?
Sure, no, it's a great question, and you know, it's easy to think that if you've just had a 50% return from equities, that there's going to be no more in the bag. Yeah. But I think that would be a mistake. The poor returns from equities that we saw in the kind of run up to the COVID period, in a sense, were, in our view, kind of in the valuation was getting cheaper, and that was kind of pushing expected returns into the future. Yeah. So, you know, there was more and more on offer, and we can see that in, you know, I think a slide that we often show to clients, where we look at the kind of current asset pricing and compare that to, you know, Prudential's view of kind of long-term fair value, you know, the red bars are taking current market pricing and inferring from that kind of prospective real returns. So there would be inflation on top of that, from the different South African asset classes. So, you know, even with the returns that we've seen in the last year, you know, our analysis still indicates that that South African equities are priced to deliver something close to a double-digit real return over the medium term. So this would be, you know, a view that, you know, in average over the next 5 or 7 years, you could see something like this. Clearly, we see returns being delivered in a lumpy fashion. So, you know, valuation is something that we always say to clients, tells you about, you know, the next 3 or 5 years. It tells you pretty much nothing about the next 12 months. Sure. So one does need to kind of be circumspect, and that's the reason why our process is patient in the way that we establish positions. You know, it did feel naturally that patience was wearing a little bit thin when we got to kind of, you know, the end of March 2020, and you know, we'd had, you know, 5 challenging, very challenging years, I think, for performance, and it was, you know, tough to kind of stick to, you know, what we've written on the tin. Yeah. And buy that, you know, more of those assets that in our view were becoming cheaper and cheaper. But, you know, that's exactly what we did, and I think the last 12 months have vindicated that. You know, looking forward, we can see, if we compare certainly our view of fair value against market pricing, that, you know, all risk assets, whether that's kind of inflation-linked bonds at current real yields of close to 4 for 10-year bonds, through to equities with that prospective real return of close to 10, look pretty compelling. Of course, the asset that looks quite challenged is cash. So, you know, we certainly for South Africa, we don't think it's a natural state of affairs for it to have a negative real cash rate. Yeah. And you know, and the Reserve Bank is you know, is talking about the point at which they might increase rates, but you know, with inflation remaining well under control in their forecast horizon, I think real cash returns are going to, I mean, they are currently very disappointing and are likely to stay kind of subdued against our kind of medium-term fair value. So you're just not going to need very high real interest rates in order to keep inflation under control. Yeah. You know, there is, in our view, an ongoing you know, a number of ongoing global disinflationary forces at work, I think, which will keep global inflation as kind of pinned at lower levels, and you know, South Africa will continue to also benefit from that long-term phenomenon, along with the fact that, you know, when individuals have reset their own expectations of inflation to kind of 4 to 5%, that affects wage setting behavior, for example, over the longer term. And you are less likely to find yourself in a kind of wage price spiral where people are forever expecting a 2 or 3% kind of real wage gain and getting nominal wage increases of 8, 9 or 10%, you know, when inflation is running perhaps at only 4. Yeah, some pretty, I think, compelling real returns. If you think about a fund like our Inflation Plus fund and how it's weighted, you know, its domestic assets are allocated firmly into, you know, those assets here, inflation-linked bonds, nominal bonds, equity, and also, yeah, as you highlighted, we still own 5% in property because, you know, it is still an asset class, I think, that's going to deliver some inflation-beating returns in the medium term. Then, yeah, that's the probability distribution in our minds of future outcomes is heavily skewed towards beating that inflation plus 5 target that we have as a medium-term objective for the Inflation Plus fund, and the balance fund similarly, with 2/3 of its allocation into equities. You know, I think it's you know, obviously one never knows what's going to be next, and none of us expected COVID and what that was going to do, but you know, we look at the probability outcomes and you know, the chance that I think, or the probabilities that a fund like a high equity multi-asset fund can deliver inflation plus 6 or 7 are as good as they've been in, you know, in the last decade.
Thanks, David. I mean, those figures certainly indicate that maybe investors out there have the opportunity at a second bite of the cherry. Thanks for your time today. This brings to a close the formal part of the presentation. We'll now move on to some of the Q&A that we received during this morning's session. Thank you.
Thank you.
David, I think we've gone a little over time with the presentation this morning, but it does provide us with an opportunity to maybe answer 1 or 2 questions from the audience. I believe we have received quite a few, the team has indicated, and that has been answered live. So let's take 2 questions. The first is on SA economic growth. Guess we've seen an upgrading of SA economic growth forecast recently. And the question is, do you think economic growth is sustainable in South Africa?
Yeah, look, it's a great question, and obviously it follows on really from the fact that we've had 5 years of very disappointing economic activity pre the kind of COVID-led global recession in 2020. So, you know, it's reasonable to ask, well, you know, what is long-term growth going to be? And you know, are we going to see that kind of lifting through some of the reforms and initiatives that the government's been setting out? I mean, the Reserve Bank's been highlighting for a prolonged period of time that we need supply side reform, and clearly we're hopeful that initiatives like the new infrastructure fund, like the push into renewable energy, are going to start to unlock you know, potential growth in SA. I mean, at Prudential, we definitely kind of acknowledge that it is extremely difficult to accurately forecast macroeconomic outcomes, which is, you know, why in our process we tend not to take you know, significant amounts of risk based on individual macro views. But, you know, we do observe that, you know, the consensus forecasts for South African GDP kind of for 2021 have been pushing up. So, you know, economists, the Reserve Bank, National Treasury, becoming more optimistic. We touched on the issue of tax revenues earlier and showing how those are overshooting, not just corporation tax, which is obviously in part kind of being driven by resources, but also the income tax numbers have been coming in stronger. reflecting some of the kind of post-COVID healing, and a number of GDP growth number of 3.5% to 4% for 2021 looks to be broadly where consensus is currently settling. I mean, that would still leave South Africa kind of below the level of output that it had pre-COVID. One or two clients have asked, when are we going to recover that full output loss? Consensus is expecting, that kind of 3.5% growth will become more like 2.5 to 2 in 2022 and 2023. So, if those numbers are right, then you're looking kind of into 2023 before we recover the full output gap. But beyond that point, I think South Africa's future is really in the hands of the politicians in terms of freeing up the economy and kind of actually putting some real effort and initiative behind the liberalisation of the supply side of the South African economy. And we need to wait and see. I think it's important to say that valuations of SA Inc. companies and valuations of SA bonds both have embedded in them some very poor macroeconomic outcomes. And that's partly why they're as cheap as they are. Yeah. So even kind of relatively modest recoveries from here, I think have the potential to continue to drive some pretty compelling returns from those asset classes.
Yeah. Thanks, David. The second question that's come through is on emerging markets. Of course, we talked about the SA valuation story and we compared it to the US. What is your view on emerging markets as a broad classification? And are you seeing some value within those other markets?
Yeah, again, I mean, we're as guilty as anybody of looking at the broad-based indices from time to time, looking at the MSCI Emerging Market Index and comparing it to world equities, and in doing that, it's easy for one to kind of forget that actually emerging markets are not a homogenous group of countries. Yeah. And there isn't a single investment opportunity which is being overweight EM in our view. There are some very different macroeconomic stories unfolding across the emerging world. You have some very different underlying fundamentals in those economies. South Africa, Brazil, Russia are commodity exporters. So, their economies very linked into the global commodities market. If you look at Korea, and to some extent increasingly China, then you're kind of much more getting linked into tech. Samsung is 30% of the Korean equity market. So, obviously you'd expect that issues like chip prices and semiconductors and so on are going to be very important for that economy, which aren't important for South Africa at all. So you really need to look on a market by market basis. Sure. And you will see in our global equity funds that we are overweight select emerging markets. We've been overweight Indonesia, we've been overweight China. The valuations look very compelling. The Chinese equity market, despite the strong recovery in macro there, has underperformed global equities materially. And obviously we're overweight South Africa in the broad context of our portfolios. But there are other emerging markets where they're looking quite expensive. India's a very expensive market, even though it has quite a high ROE. So yeah, Vishal, you just need to be, I think, quite selective and a little bit wary of lumping them all together as a category. Sure. I think one of the other things to say there is just that the sector composition of markets, given the comments I've made about structures of economy, and particularly when you're comparing to global equities, which we have to remind ourselves, 50% of the global equity market is the S&P. Yeah. So there is a big sectoral difference there. Technology stocks are now over a third of the S&P, and one needs to kind of value those in a slightly different way.
Yeah.
And so we are underweight the S&P in our global equity portfolios, but perhaps not as much as one might have thought, given just some of the kind of on the face of it valuation metrics, and that does follow from I think the fact that that there is a profound, I think, sectoral difference in the different indices.
Yeah.
So again, that's something else that I think needs to be taken into account.
Thanks, David. I think that's certainly quite a good point to make. I think we'll have to leave it there. That's all we have time for. We've gone slightly over time, so apologies for that. I'd just like to say thank you to all of you for dialing in today. We will be sending a feedback survey out tomorrow with a link to the presentation, and we will also be making the presentation available on our website tomorrow. Also importantly, CPD certificates will be sent out within the next 10 days. Thanks everyone, and thank you to David once again.
Thanks very much. Thank you.